Most people in their 20s think investing is something you start later, after you make more money, after you figure life out, after you finally feel financially stable. But here's the reality: the difference between starting now and waiting 10 years can literally cost hundreds of thousands of dollars. And the craziest part? You don't need thousands to start investing. Even $100 a month can completely change your financial future. For many young adults, investing feels intimidating. People think you need a lot of money. You need to be an expert. You need to pick winning stocks. So instead, they delay. But investing isn't really about getting rich quickly, it's about consistency. Because the real power isn't how much you invest at the beginning, it's time. Time is what builds wealth. And most people massively underestimate what small monthly investments become over decades. If you're starting with your first $100 a month, the smartest move for many people is simple. First, check whether your employer offers a 401k match, because employer matching is basically free money. For example, if your company matches 50% or even 100% of your contributions up to a certain amount, that means your investment instantly grows before the market even moves. A lot of young workers ignore this benefit completely, which is essentially turning down part of their paycheck. If a 401k match is available, that's usually the first place to start, especially because contributions are automatic, which makes consistency easier. Now, if you don't have a 401k or want another option, many beginners start with index funds, or ETFs. And this is where investing becomes surprisingly simple. Instead of trying to guess which individual stocks will win, index funds spread your money across hundreds of companies at once. For example, an S&P 500 index fund invests in many of the largest companies in America simultaneously. That means less risk than betting on one company, long-term market growth, and historically solid average returns over time. This is why many long-term investors prefer broad index funds instead of constantly trading stocks, because investing consistently usually beats trying to get lucky. Now here's where things get interesting. Historically, the stock market has averaged roughly around 7 to 10% annual returns over long periods. Of course, markets go up and down, returns are never guaranteed, and some years are much worse than others. But over long time frames, compound growth becomes powerful. Let's use a conservative long-term average around 8%. If someone invests $100 per month, here's approximately what that could grow into. After 10 years, around $18,000 to $20,000. After 20 years, around $55,000 to $60,000. After 30 years, roughly $140,000 to $150,000. And that's just from investing $100 monthly. Now imagine increasing that amount later as income grows. This is why starting early matters so much. Not because of huge contributions, but because compound growth needs time. One of the biggest mistakes beginners make is waiting for the perfect time to invest. But historically, trying to perfectly time the market is extremely difficult. Many people stay on the sidelines for years waiting for certainty, while consistent investors quietly build wealth over decades. The key isn't perfection, it's consistency. Small amounts invested consistently over long periods often outperform people constantly chasing shortcuts. For people in their 20s and early 30s, financial stability feels harder than ever. Higher rent, rising costs, debt, subscription culture, constant pressure to spend. That's why investing early matters. Because building wealth today isn't usually about one huge financial move. It's about small systems repeated consistently. And even though $100 may not feel life-changing today, the habit itself can completely alter your future. If you take one thing away from this video, let it be this: you do not need to be rich to start investing. You just need to start, because time matters more than most people realize. If this video helped you better understand investing, hit like, subscribe, and turn on notifications for more videos about money, psychology, and financial freedom. And before you leave, ask yourself this: what could your future look like if you started investing today instead of waiting another 5 years?